My greetings to all the participants. Good afternoon. I am Anil Goel, and I have along with me Mr. Ankit Goel.
Good morning, everyone.
So we are very delighted to share with you that we touched our target of 1,000 registrations for this webinar also. As in the past, the participants are giving a lot of time to us. They remain connected with us, so we are very happy. It is a very important uh, see event for us that so many participants are connected with us. The format for today's webinar would also be the same as in the past. Ankit Goel will help us in identifying the questions which are related to this topic, and he would give me the questions on an interval of about 30 minutes. So there will be 4 instances. So it is also possible that he can even give voice to any of the participant. So while we are waiting for the more and more participants, because it's like only about 2 minutes to 12, I would like to share with you my thought process on the future of the insolvency law in the country. I normally get a lot of messages and calls. Everyone is worried about the future of the insolvency law. One situation which is very clear is that this 1 lakh threshold limit has been increased to 1 crore, and accordingly one order has also been passed by Kolkata NCLT, where it is said that it is not applicable retrospectively. However, I feel that that order would be appealed, and we will see what exactly the NCLT or Supreme Court would say about it, whether this threshold limit would be applicable on the date when this application is being admitted for CIRP, or if it is applicable as on the date of filing of the application. So that concept has to be seen by the finally would be adjudicated to my understanding by the Supreme Court. See, the other apprehension which everyone is having in the profession is if it is suspended for up to 1 year period, up to 1 year, that will depend upon the situation in the country or in the world regarding coronavirus. So far the ordinance is awaited, and my understanding about the lines which are being used in the package announced by the central government is about the definition of default. The ordinance definitely is proposing to take powers with central government. Rather, the central government is proposing to take power to define default from time to time. So in this process, the central government will define from time to time what would be the definition of default. So they can also exempt some industries. They can also exempt some scenarios. Maybe in the for the minimum that they would define the default definition would be to exclude all those businesses or companies which are defaulted, which are defaulting on account of COVID-19. So this is the first thing that is apprehended, and then later on, maybe the central government may even come up with the various industries where the COVID-19 has adversely impacted, and based on the industry, also the central government can come out with the kind of definition of default. So with this scenario, I think the future of insolvency is not at all bleak. It is still comfortable because it may not be, the ordinance may not be applicable to old defaults. It may not be applicable to the existing applications which are already filed before NCLT, and it may not be applicable even for some of the future defaults which are not related to COVID-19. Even in some cases, it may be also possible that some applications, fresh applications, would be filed in NCLT, and only for those defaults which are very old defaults. and has got nothing to do with the coronavirus. So all those defaulters or all the banks would have the option, the creditors will have the option for going to NCLT. So I think the today's subject is very important for everyone whosoever is engaged in insolvency and bankruptcy practice or engaged as a banker for insolvency, because this is also very important for the committee of creditors to understand the tax impact or also understand the compliances required to be done by the RP or the liquidator. Also, when the resolution plan is approved, the impact of tax has to be seen. Otherwise, there is a possibility that a very good resolution plan would become difficult for implementation. So, and in the meantime, I would like to start this presentation. I think we have now a lot of participants already. So let me go to my. So Ankit, should
I
I
think
go
you
to
can
my?
start. Please, you can start. We are already touching 450. The number is still increasing rapidly, but I think we can start because all the people who joined us in time should not be waiting for the presentation to start.
So friends, today's subject is the Insolvency and Bankruptcy Code vis-a-vis tax authorities, statutory authorities, or the tax dues or statutory dues. So we would focus on this subject only today because this subject itself is very large and we have given 2 hours time, and we might even extend like in case the demand would be seen. So like it is not something that we can go ahead with the entire the IBC process. I understand that the participants today would be understanding IBC, the basics of IBC. So whenever the CIRP of any company starts, and the first thing is the moratorium, which actually would protect the company from various proceedings, from various litigations and recovery processes. So this also would have some implication on the tax dues, on the enforcement of the tax authorities, on the actions taken by the tax authorities or statutory authorities. So the moratorium is, when we read this moratorium, section 14, so the clause A is very important to read very carefully. It reads as the institution of suits or continuation of pending suits or proceedings against the corporate debtor, including execution of any judgment, decree, or order of any court of law, tribunal, arbitration panel, or other authority. Now, the two words are very important. One is the institution of suits or continuation of pending suits, and then the other is the against the corporate debtor. So it means that all the existing suits or proceedings would be stayed, it would not be continued, and the new institution of suits or the new proceedings would not be started. So this is applicable to tax proceedings also. This is also applicable to the tax assessments. However, the tax assessment is a process. The recovery process is a different process and tax assessment is a different process. My understanding is that the assessment is not a recovery process, it is the operations of the company to provide information to the tax official. So it is very difficult to ask the tax officials that we would not provide the information as we are under moratorium, because the tax assessment is a kind of operations of the company, and the company has to be kept as a going concern. So we, as an RP, we might have to provide the information as asked by the tax officials, may it be GST, may it be income tax, or may even be any of the past reassessments which can be done. So in case we have the information, we should provide as an RP. In case we don't have the information, we try to seek from the corporate debtor, and we should fulfill the requirement of the tax officer. So this is the one part of it, because the moratorium is applicable against the proceedings, whereas the tax assessment, it can be understood as operations of the company, and while we keep the company as a going concern, the tax assessment is not a proceeding to recover. Tax assessment is also not something which is against the company. Tax assessment is something that a tax official or any statutory authority is asking some information from us, and that information has to be provided by the RP, because the RP is presently looking into the company's affairs, company's operations. So this is a very important part that I wanted to discuss with you. like rest of the moratorium is not really important, and I also would say that this moratorium is also having a relevant section 74, where the in case anyone contravenes the moratorium, the officer of the corporate debtor or the CD, there is the imprisonment of 3 to 5 years is prescribed, and also a fine of 1 to 3 lakhs is prescribed. Any person of the financial creditor or operational creditor also, in case contravenes moratorium, the imprisonment of 1 to 5 years, and again the fine of 1 lakh to 1 crore. Similarly, in case anyone contravenes the implementation of the resolution plan, still there is a prosecution provided. Now the committee of the creditor is constituted after the moratorium, and the powers of the committee of the creditor is very well known to all of us. 90% in case it is withdrawn, and 66% for all the items were specifically mentioned as 66% voting share, and 51% is required wherever it is not specifically mentioned as 66% or 90%. For all other approvals, 51% is the required voting share for passing an order. Then the resolution professional is appointed, and there are various powers with the resolution professionals and also duties of the resolution professional. So we would only discuss about the powers and the duties which are related to the tax authorities and tax dues. See, this is the when we talk about a resolution plan, after the RP does a lot of work, then the resolution plan is received and the resolution plan is approved. And this particular slide shows the ultimate objective of the Insolvency and Bankruptcy Code. This is the left side picture is the before, where the company or the corporate debtor is suffocated because of the load of the debt, whereas on the other side, post resolution plan is approved, the corporate debtor, the business of the corporate debtor, the operations of the corporate debtor, they are very happy, they are dancing over the debt. See, however, in case everything is done very carefully, the sustainable debt has been calculated very carefully, and see, the entire COC worked very hard on the finding a resolution for the company. In case the tax implication of the resolution plan is not taken care of, then the entire implementation of the resolution plan can be adversely impacted. So that has to be seen today in this webinar, because we just want that this the corporate debtor, the operations of the company, the business of the company must keep dancing, and it should not be like the efforts of the COC or the resolution professional or the resolution applicant should not be disturbed because of the tax planning or the tax liability which is surfacing out of the resolution plan. So in case the resolution plan is not approved, we all understand that we go for liquidation. The liquidator is appointed, and the liquidator can sell the company as a going concern, or the liquidator can sell the assets of the company in piecemeal or in groups. And then the implication of the liquidator or liquidation also is there is a moratorium under section 35, and then in the liquidation steps are taken, and after the liquidation steps are taken, this is what is section 53, where the total assets available with the CD, either as a going concern or in piecemeal, would be distributed in this kind of waterfall mechanism. So this kind of waterfall mechanism is further explained by me, because this webinar is specific to very specific to waterfall arrangement, entitlement of the tax authorities under section 53. So it is very important that we should actually carefully see the section 53. This one is absolutely fine, workman dues and the debt of a secured creditor. See, coming to this, coming to the clause E, the following dues shall rank equally between and among the following: 1, amount due to central government, and any amount due to the state government, including the amount to be received on account of consolidated fund of India and the consolidated fund of a state, if any, in respect of the whole or any part of the period of 2 years preceding the liquidation commencement date. Now, this 2-year is very, very important that I wanted to highlight. I also wanted to highlight that on account of Consolidated Fund of India or Consolidated Fund of State, I also wanted to highlight the central government and the state government. So the statutory dues, the tax dues that I'm trying to refer today is only these tax dues or statutory dues. Actually, normally this is basically confused with the other statutory dues that normally we've been seen in our uh, practice area as a chartered accountant. In most of the cases, the provident fund or the ESI, these are also at times are considered as statutory dues. You see, however, as per the definition of Section 53, these are outside the dues which are meant as statutory dues, tax dues, which are meant as operational creditor. You see, in the entire concept of tax dues and statutory dues. So in tax dues and statutory dues, this provident fund and the ESI, it can be referred as a workman dues or employees dues, but it cannot be referred as the statutory dues or tax dues. And it is also important that we should say it is only whole or any part of the period of 2 years. So this clause E refers to only the statutory dues or the dues to central government or state government, any amount payable to Consolidated Fund of India or Consolidated Fund of State, and that should pertain to whole or any part of the period of 2 years preceding the liquidation commencement date. Coming down to clause F, any remaining debt and dues. Now, the remaining debt and dues can be defined as workman dues beyond 25 months, because we had seen, in case we go back, we can see here the workman dues is also defined as workman dues for the period of 24 months preceding the liquidation commencement date. On the next slide, we also see the wages and any unpaid dues owed to employees other than workmen for a period of 12 months. Then we actually come down to this last, which is clause F. So anything which is over and above 24 months and for workman dues would fall here. Any amount which is due for a period beyond 12 months as regards employees, that also will fall here. Amount due to government authorities or Consolidated Fund of India or Consolidated Fund of State beyond 2 years will also fall here. So any other party who has supplied goods or services would also fall here. So this is very, very important to see that the clause F and the clause E, there is a difference in the priority. There is a difference in the priority, and only government dues up to 2 years has a priority over the other operational creditors, that is the suppliers of goods and services. Otherwise, beyond 2 years, the government dues, statutory dues are at par with the operational creditors, means the suppliers of goods and services. So this understanding is very, very important. So in case we are unable, you see, after the liquidation, then we go for the dissolution. Now we come to the tax dues, because this was only a preamble to our tax subject today. We discussed moratorium and we discussed the section 53. So who is entitled to at what priority to get the distribution of the assets of the company. Now let us understand again the impact of moratorium under section 14 of the IBC on the tax authorities. First, we talk about the moratorium during CIRP. Again, reading carefully is the start of fresh proceedings is prohibited against corporate debtor. Continuation of pending proceedings is prohibited against the corporate debtor. Third is the execution of any judgment order is prohibited during CIRP. Any action to recover any dues is prohibited. I have only taken relevant clauses because see, we are only talking about the tax dues and we are not talking anything else today. During liquidation process, the very conspicuously, you probably would say section 33(5), subsection 5 would say start of fresh proceedings is prohibited against the corporate debtor. However, the word continuation of pending proceedings is missing here. And since we are handling almost 33 liquidation cases under a AAA insolvency banner. So we understand that once the liquidation process starts, the various proceedings which were under, which was the old proceedings, which was kept in abeyance during CIRP, on the liquidation order, all those proceedings may start. Then the continuation of the proceedings is not prohibited. Liquidator will take into control and custody of all the assets. That's section 35(1)(b). Any action to recover any dues is prohibited, as the claims would be filed by all the creditors. The other powers that we can see and use against the tax authorities is section 17(2)(d). IRP, RP shall have the authority to access the books of account, records, and other relevant documents of corporate debtor available with government authorities, statutory auditors, accountants, and such other persons as may be specified. I believe that the RP or the IRP can even write to government authorities, to the income tax authorities, to the GST authorities to provide information to RP as per this power, section 17(2)(d). In case the IRP is not getting any cooperation from the promoters, then the information can be taken from the government authorities in case it is available with the government department. The second, which is very important power of the RP, is that to take control and custody of any asset over which the corporate debtor has ownership rights, including the assets that may or may not be in the possession of the corporate debtor. Section 18F subclause 2 and section 25(2) subclause A can be seen with this regard. So that means that in case there is any asset which is in the name of the company, even if it is attached by any tax authorities or statutory authority, the liquidator would have, the RP would have the rights to take control and custody of that asset, irrespective of any attachment. So this section helps us in taking over all the attached assets by any statutory authority or tax authority. To file an application to NCLT and seek directions against any such person who is not cooperating with the IRP, RP, that of course everyone knows, section 19(2), that option is also available with the IRP, RP. The most important part that we have to see is section 18F subclause 2, section 25(2) subclause A, which actually empowers the RP, IRP to take over control on all the assets, even if it is not in the possession of the corporate debtor. So even in some cases where the attachment has been taken or even the possession has already been taken over by any statutory authorities, that also can be taken back. It is not only simply attachment, even the possession also, in case it has been taken, it can be taken back by the RP. Now, in case other powers that we see under the code, similar powers are given to the liquidator in the liquidation process. All the assets of the corporate debtor, if attached by government authorities against tax dues, would be released in favor of the resolution professional or liquidator. Some of the examples are bank accounts, movable or immovable properties, or even any other debtors or any other stocks or any item or any shares or any investment. Anything can be detached based on these powers with the IRP. So IRP can make an application to the statutory authority. So in case the statutory authority does not decide about it, then or does not cooperate, then the application can be submitted to NCLT under section 19(2), and direction can be sought against the statutory authority. However, if the assets are realized and adjusted against the tax, so I just want to discuss one example. That for example, in the case of a search, the assets like cash has been confiscated by the income tax department, and then the same has been deposited in the account of the corporate debtor as tax. So that cannot be brought back. That cannot be refunded to IRP. We are only talking about all those assets which are in the name of the company. So that would be considered as an advance tax payable paid to the department, and that would be claimed as a refund of the advance tax. But anything like any bank account or any locker or any property or any investment or any shares, whatever has been attached by any statutory authorities, when we talk about statutory authorities, it can be any authority which actually can be central government authorities like income tax department, GST department, or any other department which is levying any tax. State government also levies a lot of taxes, so any amount which is pertaining to the state taxes, that also we mean the statutory dues. In the meantime, the IRP is also supposed to comply with certain duties. This section 17(2) subclause E says that the IRP shall be responsible for complying with the requirement under any law for the time being in force on behalf of the corporate debtor. So that means that the RP is supposed to comply with all the TDS compliances, TCS, payment of income tax, filing of returns during CIRP, all has to be done because the company has to be kept as fully compliant, and it is the responsibility of the RP under section 17(2) subclause E. Then the tax authorities are supposed to file their claims, and they are supposed to participate into the resolution process of the corporate debtor. See, when they file their claims, we are also going to discuss their rights in the CIRP during the CIRP process. So section 5, subsection 20 defines operational creditor means a person to whom an operational debt is owed and includes any person to whom such debt has been legally assigned or transferred. Section 521 defines the operational debt means a claim in respect of the provisions of goods or services, including employment, or a debt in respect of payment of dues arising under any law for the time being in force and payable to central government and state government or local authority. So the local authorities also included, state authorities are also included, central government authorities are also included in the definition of operational debt. Regulation 7 says that the claim would be filed by the operational creditors in Form B of the CIRP along with the proofs, documents, clarifications. Claims can only be filed for any amount from the corporate debtor irrespective of any appeal pending. But the claim can only be filed with the demand raised. It cannot be filed for anything which is not raised. Demand has to be appropriately raised. Maybe an appeal is pending, maybe an appeal is preferred by the corporate debtor, but the demand must have been raised, demand notice must have been given. That is what is considered as claimable amount. See, when the tax authorities file their claim, it becomes their right to get a notice of committee of creditors meeting, and it is their right to attend the meeting under section 24(3) subsection C, subclause C. However, this right is only restricted to a case where their total aggregated dues are 10% or more of the total claims. The operational creditors, similarly, government authorities will not have any right to vote in the committee of creditors. Regulation 16 also says very clearly that in case there are no financial creditor, then the operational creditor will form committee of creditors. And in such cases, in case the name of the statutory authority figures in the top 18 operational creditors, then the tax authorities or statutory authorities will also become part of the committee of creditors, and they will take all decisions along with other 18 members for the resolution of the corporate debtor. Government authorities would also be filing their claims during liquidation process, and then the form for the claims is Form C, which would be filed by the statutory authorities along with all the evidences. See, while we verify the claims filed by the tax authorities or statutory authorities, we should actually try to see following checklist, which is very, very important. Proper form should be used by the authorities, same during CIRP and the liquidation process, because the forms are different for both the processes. Authority of the officer filing the claim and signing the claim document also should be seen, or the document should be available. Certified copies of the assessment order, appeal orders should have been attached by the tax department. Recovery certificate under Section 222 of the Income Tax Act is issued or not. That has to be seen by the RP or IRP. Disclosure of any appeal filed by the assessee or not. A relief given by any appeal order is affected or not. Information can be obtained from the corporate debtor also regarding the statutory dues, and based on certain NCLT orders, it has also been held that in case the tax authorities, statutory authorities are not filing their claim, then the information memorandum should contain the information based on the provisions made in the books of account or based on the litigation details given by the corporate debtor. So that should be part of the information memorandum. All tax disputes, all statutory authorities dues, and all disputes with the statutory authorities should be part of the information memorandum. In case the claims are not filed, it becomes the duty of the RP, IRP to take this information from the corporate debtor, provide this information in the information memorandum, and also in case the claims are not filed, it should be followed up. All the tax officials or the statutory authorities should be contacted so that they are able to file their claims.
So
So
one of
in
the
case any,
questions, so
yes,
one
yes.
question that has come in is that is there any limitation period to these claims? So if statutory due, so one of the examples that one of our participants is asking is that if the claim belongs to say a very old year, say 10 years back, and the tax authorities are not able to show any reiteration of that claim over the last many years, will there be any applicability of any limitation act on the claims of government authorities?
See, the claims of the government authority, and that too, in case you see that there is no appeal pending, there is no litigation pending, and still the claim is pending, I think it is rarely seen. But in case there is no action by the tax department for a period which is provided in the Limitation Act, I'm not sure whether this period provided for this kind of dues is 3 years or 9 years or 12 years. Whatever is the period provided for the tax dues, a limitation period that has to be seen in the Limitation Act, and the Limitation Act would be applicable. See, however, like any kind of notice or any kind of litigation which is there, that would actually be considered as a renewal of the debt.
Okay,
Any other
and
question,
the
Ankit?
second question that was a little relevant at this point in time was with respect to what if, so if no claim is submitted, a few questions are that what happens if no claim is submitted? Alternatively, the same question can be rephrased and we can say that what should be the urgency for the RP to seek the claims for statutory dues? If so, how does that help in case the RP contacts the regulatory bodies and seeks a claim, and what is the benefit of doing that, and what happens if no claim is received despite doing that?
So in case no claim is received, then the first duty of the IRP RP is to take this information from the corporate debtor. Also take this information from the litigation, the details of which would be provided by the corporate debtor. Accordingly, build this information into the information memorandum so that it is never said later on that the claims or these liabilities were never ever considered in the CIRP process. So we should always consider these liabilities in the CIRP process. While I will go forward, in my slide you would find there are judgments by a few high courts where it has been said that unless the statutory authorities participate into the resolution process, the resolution plan cannot be binding on them. There are two such judgments. So maybe because of these two such judgments, the tax authorities are at times not filing the claim. However, in case there are evidences that the information memorandum contained the information about the statutory dues, in case there is an evidence that yes, the RP approached those authorities and they did not file their claim, so that would not be considered as something which is held in those high court judgments. So the urgency is that yes, we would like to involve them into the process uh, according to some high court judgment, which probably it is not so far very, because the Supreme Court has decided even after that that the money due to the operational creditors would be as per Section 53. including the statutory dues. So those judgments may not be relevant, but yes, still there is a possibility of litigation. So therefore, in case the resolution during the CIRP, in case their claim is filed and they participate into the resolution process, or their debt is considered in the resolution plan or in the information memorandum plan specifically, then it would be very difficult to say that this resolution plan is not binding on those statutory authorities, because they would be considered as participated in the resolution process.
So another question that is coming out is that is there any difference between claims of direct taxes or indirect taxes in the waterfall mechanism? I don't think there is. I think you can clarify that at your end
No, there is
also.
no difference. As I said, all statutory authorities, statutory dues due to central government, due to state government or local authorities, all are having the same priority, and there is no difference in any of the priorities of the under Section 53.
Another question that might be relevant at this stage, and I think this will be the last question, then I'll ask you to resume. The question is basically something that you keep reiterating again and again, that during the moratorium period, we should we should fight those claims or participate in those proceedings where there might be some kind of a possible gain or possible refunds available to the company from the department. So maybe you can throw some light on that part as to when a show cause notice is received, when an assessment is pending, when an appeal is pending, which ones do you recommend the RP to follow up, and which one you kind of recommend that can be put into the moratorium. Also, what can maybe we can also discuss on the second question, that how does the valuer play a role in the valuation of these statutory dues, which sometimes lie as assets in the company balance sheet?
So I think let's take this first part. The one is the valuer. Valuers are definitely making their own assessment about the recoverability of all the dues. When the valuer asks questions from the IRP, RP, the valuer should actually be getting this information about the litigation, about the kind of case, about the kind of pending demands before the income tax authorities. So normally in some cases it becomes a very big issue that there are 4 crores, 10 crores, 20 crores demand income tax refund is due, and most of the valuers are valuing it to zero because of the
Lack
flow
of
of
documents,
information,
mostly
lack
lack
of
of documents.
documents, or lack of documents to rely on. So one, that the valuers should value it carefully. Valuers should not always say zero. In case the existing demands or litigation with the corporate debtor vis-a-vis tax authorities is not much, the tax refund definitely should have likelihood of receiving that amount. Similarly, for the purpose of assessment proceedings, or for the purpose of reassessment proceedings, or for the purpose of appeal proceedings, these are all the proceedings which is a part of the operations. The moratorium probably would not be applicable on the proceedings, and it would become duty of the IRP or RP to continue the operations. Moratorium is on the recovery process. Moratorium is on the process where the assets of the corporate debtor are attached, or there is a forced recovery, or there is a forced kind of cases which requires because of some defaults. So in this scenario, my understanding with the after handling more than 155 cases of CIRP and liquidation, my understanding is that in case the IRP RP has information, RP should continuously provide it to the tax authorities. In case it results into a refund, in any case that becomes the duty of the RP to protect the assets and the preserve the assets of the corporate debtor. In case it turns down to liability, then it also can actually be considered as the lack of due diligence used by the RP, and the demand is created. It is a separate issue whether the demand would be payable or not, whether the liquidation value of the company would be to the pay would be enough for payment of statutory dues or not. That of course we will see after this session of question answer. But the assessment proceedings, reassessment proceedings should be continued. It might even result into some refund, or it might even result into something which is a very, very exorbitant demand in case we don't attend to these proceedings. Uh, the income tax officer, the GST official, they actually have to reach out to the corporate debtor. The corporate debtor is presently under the custody, control, and operations of the RP. So there is nobody else other than RP who would provide information. Normally, we hire the same chartered accountant who is continuously handling the income tax cases or GST cases of the corporate debtor, because he would have the files and he would have all the information. So we have been doing that. And now even the income tax department has also amended that the RP also can represent. RP has actually become authorized representative under the Income Tax Act for the purpose of the assessment proceedings of the corporate debtor. That has also been amended. So I think, Ankit, this takes care of the question session this time.
Yeah, I think I will just at this time it takes care of it. I will just like to add something. So basically, I also will like to say that crystallization of demands and possible refunds at any stage during the CARP will also perhaps help the resolution plan process. Because if there is certainty in the whole process, then I think everyone will agree that there is more possibility of plans coming in with certainty being in place with respect to the demands or refunds. Also, income tax portals can give a lot of information on pending TDS, pending returns, and maybe that is also one source for resolution professionals to bring some money into the company.
I think you were also talking about something that with all the RPs can do regarding the if you take the email IDs of the corporate debtor, or see, I think you can discuss something about that, because that also gives a lot of information about the company.
So there is a
And
so
you
there is
were
a
also
lot of
talking about the
yeah. Please go ahead. Sorry.
yes. You see, I think you were also talking about something where you can go and understand the earlier part of the websites of the company, so that the information can be obtained by the RP. So can you discuss that a little bit?
So there is a very, very interesting tool available on the net which archives websites. It's called Wayback Machine. And if somebody looks for this, Googles it, they can approach and they can open up that archive site. That archive site is available to everyone, and it shows a time-based changes, time-wise changes on the websites that it has recorded. So what it can offer is it can offer the sitemap of the website, which is now put down by the promoters of the CD, or which is no longer available. It can really reveal information on the available email addresses, the contact numbers that were used for the business of the assessee. So that kind of can throw a lot of light on the email addresses and other information available. Of course, when you talk about income tax portal, there is also a mechanism to take control of the income tax portal. And once you do that, you can access all the tax audit reports, all the ITRs, all the pending refunds, all the pending demands, do a detailed analysis. So I think that is what I was mentioning earlier.
So one which is very, very important information which Ankit has provided is that we should, as RP, we should always go to the all the websites of the group companies, and we should use the Wayback Machine tool, and we should see what were the information provided on these websites about a year back when the company was healthy and the company was not defaulting. Maybe that you would find a lot of contact details of the directors, employees, and also a lot of information about the immediate past of the companies, or also maybe information about various other associate companies or various other projects of the same group, which probably when the promoters would understand that the company is going to CIRP, they would delete all those. But then the Wayback Machine would help you in getting into the old contact numbers and telephone numbers and email IDs. Ankit, is there any way that we can also take hold of the email IDs of the corporate debtor and we can go back to 2 years so we can find all the emails? Because see, whenever
I
an
think
email ID is given to us, they would delete all the earlier emails.
I don't
How
think
can
there
we
is any
go back to
possibility
threshold?
of I don't think there is a possibility of retrieving old emails. I think that can only be understood as a as I think a default in handing over the company's entire process. And I don't see any approach where we can approach say Gmail or any other email service provider to take control of the organization's email. Not seen that so far.
See,
but
but
it's
very,
worth a
very
try.
important, very important part is that all these digital assets are part of the property of the company. And in case any property of the company is stolen or damaged or taken away from the registered office, including books of account, then it becomes a case of prosecution under Section 69, under Section 68. And then the IBBI also recommends that in such cases you can file a prosecution application to IBBI, so that the any promoter or any key managerial personnel of the company, in case they are trying to conceal, they're trying to damage, or they're trying to take away any of the property of the corporate debtor from the registered office of the company, immediately the complaint should be filed for the prosecution, and that can be filed to prosecution department of IBBI. So that can be filed under Section 246, I believe, maybe 236. Yeah, 236. So this is also one of the remedy available, because see, nowadays we are seeing that Section 19(2) application is not really very, very impactful. But yes, we can still make efforts to add some more force on this efforts of the RP to collect information. Coming back to
I think
the
now, yeah, you can. I think you can
yes,
proceed with the presentation.
yes. Coming back to the definition of operational creditors, right from the beginning, there has been various judicial pronouncements regarding whether the statutory dues, tax dues are operational creditors or not. The first judgment came in the name of Principal Director General of Income Tax versus Synergy Dure Automotive Limited, where it was held by NCLAT that the Income Tax Department of the central government and the Sales Tax Department of the state government and the local authority who are entitled for dues arising out of the existing law are operational creditors within the meaning of Section 520. Then the similar thing was repeated in Kiran Global Chem Limited by NCLAT, and it was the NCLT held that the tax department would fall under the category of operational creditor. See, in Andhra Pradesh High Court, in the case of Leo Edibles and Fats Limited, it was held that the tax department triggered controversy by insisting on having priority in the collection of past dues from the companies going through a resolution mechanism under IBC. It was held by the Andhra Pradesh High Court that the department cannot claim such priority. The priority has been changed under Section 53 of IBC, and because of non-obstante clause, Section 238 of IBC, it is actually very important for everyone to understand that then the priority in collection of statutory dues have changed under IBC. Similarly, Kolkata High Court also passed an order in the case of Akshay Junjunwala versus Union of India, and it was held by Kolkata High Court that the term operational debt would also include a claim of statutory authority on account of money receivable pursuant to an imposition by a statute. Similarly, the another judgment, which is Principal Commissioner of Income Tax versus Monet Ispat and Energy Limited, it was held that the moratorium under the IBC will apply to the order of the Income Tax Appellate Tribunal. The Apex Court, the Supreme Court, this is a Supreme Court judgment, made it clear that the income tax dues, being in the nature of crown debts, do not take precedence even over secured creditors who are private persons. The sales tax department, state of Maharashtra versus New Falton Sugar Works Limited. This is an NCLAT judgment where the appellant means the sales tax department, state of Maharashtra, is an operational creditor. Provisions of Maharashtra VAT 2002, creating first charge on its favor, gets eclipsed under the overriding effect of provisions of Insolvency and Bankruptcy Code. COC approved resolution plan is beyond the pale of challenge before the adjudicating authority or before the appellate tribunal. The Ultratech Nath Dwara Cement Limited versus Union of India, Rajasthan High Court passed an order. In this case, after the resolution plan was approved, the various demand notices were issued by the statutory authorities against the company, which has been taken over by a resolution applicant. After the resolution plan is approved, various notices are received. Rajasthan High Court quashed all the demand notices and other demands which they may contemplate for the period prior to resolution plan being finalized, the demand notices are ex facie illegal, arbitrary, and per se, and cannot be sustained. So this was a very, very strong order written by Rajasthan High Court, which not only quashed all the existing demand notice and also the demand notice which can be contemplated for the period prior to the resolution plan being finalized. So all these notices were being quashed, and also it was quashing the notices which can be contemplated by anyone. So that was the scenario which was closed. However, in the case of Electro Steel Limited versus State of Jharkhand, the Jharkhand High Court in fact it was held that the resolution plan cannot be said to be binding on the Commercial Tax Department of Jharkhand, as they were not participating into the resolution process. This is the only thing that I cautioned you, that the participation has to be done, the participation should be done. However, there has been various other mandates which says that even if the liabilities are contingent, even if the liabilities are crystallized, even if the liabilities are not crystallized, anything which is up to the date of approval of resolution plan cannot become the responsibility of the RA. For the period of CIRP, it is the responsibility of the RP, and for the period prior to the CIRP, it has to go as per Section 53. And as per Section 53, if there is anything due to the operational creditor, it must be given to them. In case there is nothing due to the operational creditor, then zero would be given to them. So that also has been clarified, that it is not important that every stakeholder should get something out of the distribution of the assets, either in resolution plan or that is also not really important now, that the statutory authority should be offered at least 1%, 2%, which actually we have seen in some of the resolution plans. The matter is very, very clear now that if the liquidation value is due to them, if there is anything which is payable to them in case the company goes into liquidation, that is the total entitlement of the statutory dues, and that must be paid, and there is no way that we cannot pay that. If we have to pay that, that's a mandatory condition. In case we don't do that, then the resolution plan would not be approved. Rights of the tax authorities is very important again under the liquidation process, because we have seen CIRP and we can see now the liquidation process also. Government authorities have been given 1 seat on the stakeholders consultation committee. Total seats, maximum seats under the stakeholders consultation committee are 11, and 1 seat is given to the government authorities if there are claims filed by the government authorities. Irrespective of the amount of claim, they have 1 seat. The stakeholders consultation committee members are not having any power except to observe the process of the sale of assets and understand the liquidation value. Stakeholders consultation committee can direct the liquidator to do some acts or not to do some acts. However, the liquidator would still have powers to do as he deems fit after recording reasons. So the logic why the tax authorities was also made a part of the liquidation process primarily was to provide them the information about the liquidation value of the company and also the total claims on the company, and whether they would be actually entitled to some amount under Section 53 or not. So this is the stakeholders consultation committee would get the information, and accordingly they can understand and they can convey to their department that in this case nothing is possible to be recovered because the liquidation value is much less than the our entitlement. See, the other part which is primarily for the tax department, that the tax department can also initiate CIRP to recover dues. This part when I delivered it to I might even share with you that I was also one of the faculty which was deputed for providing awareness and education to all the tax officials regarding insolvency and bankruptcy law and the tax laws. This was a project started at the instance of CBDT and IBBI, and some of the faculty members were selected, and we were given a task to go to the offices of the Chief Commissioner of Income Tax at various locations and spread around the provisions of IBC vis-a-vis the tax authorities. I still have the memories that I did go to Bhubaneswar, I did go to Ahmedabad, I did go to Delhi. So there are many such training sessions that I have conducted. Normally, it would be for about 3 to 4 hours. But today, we have only conducted 2 hours because the IBC is not a subject. But whenever we were going to the tax officials meet, it used to be IBC as well as the tax provisions. So this was a slide which used to be liked by them, because whenever I shared with them that the tax authorities can also initiate CIRP to recover dues, this made them very happy, because they also face a lot of recovery issues. However, the only hurdle is that the assessee normally dispute the demand and files an appeal. So in case of disputed demands, the section 9 application is not possible. So the operational creditor can initiate corporate insolvency regulation process. CIRP can be initiated only on occurrence of default. First step is to deliver demand notice to make sure that no dispute is pending. This is the only part which is important, to make sure that no dispute is pending before any authority before the delivery of such demand notice, and no payment has been made by the corporate debtor after the expiry of the term. So this is the way the tax authorities can actually recover the amount. Then the see, this was much liked by the TDS department, because in TDS department most of the assessees, they file their TDS return but they don't deposit tax, and there is no appeal pending and there is no dispute pending. So in such scenario, it is actually very important to for the income tax department to file the CIRP cases against all these kind of parties who are not paying money. Then we also have to know, coming back to, so we have seen the tax authorities claims. We have also seen that they are operational creditors. Now we actually coming to a subject which is the tax treatment, the treatment of tax dues in a resolution plan. Going forward, then we will also discuss the implication of the waivers on the resolution plan and how to structure a resolution plan so that it becomes a tax friendly resolution plan. So each resolution plan must provide for payment of debt of operational creditor which will not be less than. So this is what is provided under section 30 of the code. Section 32 sub clause B1. It says that the amount to be paid to such creditors in the event of a liquidation of the corporate debtor under section 53. So the first subsection 1 says that the amount to be paid to operational creditors would be the amount payable to them under section 53 in case the corporate debtor is liquidated. Second clause says that the amount that would have been paid to such creditors if the amount to be distributed under the resolution plan has been distributed in accordance with the order of priority in subsection 1 of section 53. Higher of the above two amounts would be the amount which is payable to operational creditor. Now this is where I want to use an example, that something like maybe there is a liquidation value of a CD is 100 crore, and based on that 100 crore, there is nothing which is payable to operational creditors, because the debt above the operational creditors are much higher. However, somebody submitted a resolution plan for 200 crores, and once the resolution plan is for 200 crores, then after allocating to the CIRP costs, secured creditors, unsecured creditors, workmen, employees, then there is an amount which is payable to the operational creditor, maybe 20. So in these two clauses, one is that in case the company is liquidated, that is the calculation based on the liquidation value as per the valuer's report. 20 is the amount which is available to the operational creditors based on the liquidation, based on the resolution plan submitted by RA. So whichever is higher means 20 is the amount which has to be paid to the operational creditor. So this 20 would also include the tax dues. This 20 would also be payable pro rata to the tax dues, to statutory authorities, central government authorities, state government authorities, local authorities, all. It will be paid pari passu to all of them. Suppose one example that 100 is the total debt, total amount of operational creditors, including workmen and all, then 20% will be paid to all. So that's what is the section 32. It is the meaning of this. In the case of the liquidation value, of course, is in case the liquidation value of the corporate debtor is higher and other creditors which are higher on priority under section 53 are being paid, then dues of the government authorities would also be paid in the resolution plan. So like here, I would like to just insist and just focus on one thing, that in case the assets are available with the CD to the extent that it is payable to operational creditor, then it has to be paid. There is no possibility of any waiver. In case the assets are not available under section 53, then it is not to be paid. Whether it is waived or not waived, it is not to be paid. So when we prepare a resolution plan, we only have to see if liquidation value is enough that some amount can be paid to operational creditors. So if it is not enough, then the operational creditors would not be paid. And whenever we talk about operational creditors, I think it is the same situation under the code. May it be a workman, may it be an employee after the 24 months and 12 months, and then may it be a supplier of goods or services, everyone is an operational creditor. So whatever would be the claims under that category, under that clause of the section 53, and whatever is the amount available, that would be allocated pro rata. There would not be any difference in the supplier of goods or a supplier of services or the tax authorities or the statutory authorities. There would not be any difference. It is only and only restricted to the amount available under section 53, and that would be paid. So in some of the real estate companies that we are handling, we see that the assets are much more than the liabilities. In all those cases, it is not possible for us to seek waiver for the statutory dues, because the statutory dues are payable because the liquidation value is due to them, and it is a mandatory content of the resolution plan. The mandatory content under section 30 says that whatever is the amount payable to the operational creditor, if the company has to be liquidated, or in case of the resolution plan, that has to be paid. So in case we don't pay that, the resolution plan would not be approved by the adjudicating authority or even by the COC, because the mandatory contents of the resolution plan are not even complied with. So let us take some of the other examples. Like in case the liquidation value is low, as I was trying to explain to you, and the other operational credits are not being paid, then the dues of the government authorities also would not be paid. Liquidation value is again the same, whatever is the assessment by the registered valuers approved by the IBBI, and the average of the two registered valuers will become liquidation value. Claims are remitted by a resolution professional in order of priority, and the liquidation value of the corporate debtor are very important information for the government authorities to understand. See, whenever we go to government authorities, they would ask us, because see, now they have also been trained, and whenever I have gone for their training, I have always insisted that this basic information, whenever any RP tells you that nothing is due to them and I would not be able to give you any money, then you should ask for the information. The minimum information is the amount of total debt and the liquidation value of the company. Amount of total debt and the liquidation value of the company. This is the basic information. And also, in case you can find out information memorandum, whether our dues were being considered, whether the statutory dues were considered in the information memorandum or not. So these are the three documents which they would even insist when if they come to CIRP meeting because of the operational creditor amount, or if they come to the SCC, they also will ask this information, and they have a right to ask for this information. Of course, the timing would be important. The timing of sharing the liquidation value would only be after the resolution plans are being examined. So then they have a right. Based on this information, they would see whether this amount is receivable or not, based on this information. And however, also, because they can keep a track on the corporate debtor, if any of the asset of the liquidator is sold at a very, very high price, so the entire liquidation value is considered as very wrong, then of course there is a scenario which can actually turn in favor of the operational creditor, including statutory dues, and that can be paid to the statutory dues. Operational creditors have a right to get copies of the resolution plan and also to get the liquidation value as per the provisions of the code to understand their rights under the resolution plan. I'm not saying if they are not member, they should be getting that at that time. But whenever we go to them that your dues cannot be paid because the liquidation value is not due to you, then they have a right to ask for this information. They have a right to ask for the information memorandum, liquidation value, resolution plan, total debt of the company. All this they have the right to ask, and based on this, they would make an internal decision whether to write off the dues or to take any further action. So, and now coming to the various very common questions which are normally received in various seminars, pending assessments during CIRP and in the resolution plans, during corporate insolvency regulation process. Uh, the assessment proceedings during the CIRP can be kept in abeyance as the information may not be available with the resolution professional. So I say that one, that it actually becomes the responsibility to comply with the requirement of the assessing officer. However, in case the information is not available, you can actually write to the assessing officer that information is not available. Section 19(2) application is filed. Whenever I will get the information, I will provide it to you. Even section 60 subsection 6 of the code provides that any period of limitation would exclude the period during which moratorium under IBC was in force. So when it is said period of limitation, it means that any period of limitation in any other law. So in case the tax department tells us that I have a time barring assessment, and then we can refer them the section 60 subsection 6, which provides that the any period of limitation in any other law can also be extended based on the moratorium period, which can be excluded. The assessment proceedings can be resumed after the resolution plan is approved or the liquidation order is passed. Then information flow would be better. Any demand raised by the government authority for the period up to the commencement of CIRP would be dealt with as provided in approved resolution plan or would be dealt with as per the liquidation process. Generally, all the resolution applicants are asking for waivers of the dues of the government authorities in case no liquidation will is there. See, like every resolution plan is asking for these waivers. However, I don't see any order which provides for the waivers, or even if the waiver has been provided in any order, that is based on the only fact that the liquidation value is not due to the operational creditors, liquidation value is not due to the statutory dues. So in this scenario, the amount due to a supplier or amount due to a government authority is same, is having the same treatment. Both have the same rights and obligations. However, the statutory authorities have been given one seat. Similarly, the operational creditor, the operational creditors have also been given a seat on the stakeholders consultation committee. So the scenario is that there is no difference between a supplier of goods and services and the statutory dues. Even if such specific waiver is not asked for by the resolution applicant, the amount of such dues to government authorities would not be recoverable if no liquidation value is due. Similarly, we can also try to see what are the scenario when the pending assessments are there during CIRP, so and or during the liquidation process. The pending assessment or any other proceeding would be revived, and the assessments, if you had made them to wait for some time, again would be revived during liquidation process, and it would be completed based on the information available. See, practically what we do, we understand ourselves first of all whether the liquidation value is due to operational creditors, statutory dues. In case we see that yes, the company is an asset-rich company, however, it actually defaulted only because of the timing of the fund flow, then we actually will be very careful to provide information to the tax authorities so that no exorbitant demands are raised by the tax authorities and the entire resolution process may not be disturbed. So we keep on providing information. However, in case we find that the liquidation value is not enough, it is not even enough for the secured creditor, then we can even tell the assessing officer that information is not available with me, and you can pass an order on merit. And once the order is passed on merit, the demand can be notified to the resolution applicants. The information memorandum can be amended, and it can be considered in the resolution plan that again, as against this, the amount paid is nil if no liquidation value is due to them. During liquidation also, no enforcement can be done to recover dues, and no assets can be attached, as the liquidator has been appointed and he has the power to take control and custody of all the assets of the corporate debtor. The claims would be filed by the government authorities before the liquidator. That has to be done. And the dues of the government authorities will be paid as per the priority. That's what is the liquidation process. So Ankit, I think now I'm moving on to the income tax provisions and also some of the GST provisions. So is there any relevant question?
One question that is needed to be dealt with is PF dues. So some people are asking that PF dues have double claims. Say the workers are also saying that we have not received our PF in our account because the company has not contributed the PF to the PF fund. Similarly, the PF department may also come back to the company and say that the PF dues are still pending, the employer dues especially, or maybe even the employee dues, which the CD has deducted from the employee's wages and not deposited with the PF department can be pending. So some clarity on this whole PF thing and how it will fall into the waterfall mechanism with respect to the dues to wages and workers, and the whole waterfall mechanism
Okay,
is also associated.
let me handle PF, Ankit. The PF, primarily the PF, so basically, first of all, we will divide PF into two parts, and PF is only payable if the wages or the salaries are paid. And if no salary or no wages are paid, there is no possibility of any demand of provident fund. So the provident fund is directly related to the salaries paid or wages paid. Any unpaid salaries or any unpaid wages, that would not have any claim of the PF department. So the first thing, the clarity that must be taken. Secondly, so in case the salaries are paid and the PF is deducted, so the first part is the employee contribution and the second part is employer contribution. See, as far as this, I understand the employee's contribution to provident fund. I see, as a corporate debtor, I should not own that fund. That is a fund which is with me only as a trustee, and that should actually be deposited even beyond the liquidation estate. That may not be even part of the liquidation estate as provided in section 36 of the code. As far as the employer's contribution is concerned, that would be considered as workman dues, and the workman dues should be considered according to the periodicity and also according to the priority under section 53. So we are like handling many cases, even Moser-Beer case is also guidelines on it, but certainly in Moser-Beer cases, while this order was passed, I don't know whether it was represented like this or not. The issue of PF on the salaries which has not been distributed was not discussed. Even the employer contribution and employee contribution was also not bifurcated in that order. So in the Moser-Beer order, these difficulties were there because that particular matter was not even raised by any person representing the parties. So employer contribution should be considered as a workman dues. Employee contribution should be outside the liquidation estate, and any PF on the unpaid wages, that would be considered as workman dues and would be handled under section 53 as workman dues. Anything else, Ankit, on PF?
That's it. That's already answered. And apart from that, I will just look at any other questions that might be relevant at this stage.
See, in case you can also read out the name of the person asking
yeah,
question.
I will do that. So some questions are so one question that came in. I will have to locate the name. The interesting question that what if there is an income tax liability or some statutory liability that has come up for the period of CIRP? So say a company has active operations, let's assume, and it has some dues for maybe income tax coming in, maybe TDS coming in. So I think those are payable and those compliances need to be completed. Maybe you can throw some
No,
light on those
it is very,
liabilities.
very clear. The assessment might even complete during CIRP. The notice might even come for the first time during CIRP. The notice of demand is raised during CIRP. That has got nothing to do with the CIRP period. That is not a CIRP cost, because this particular tax pertains to an earlier year. This tax pertains to an earlier year which is being assessed in this year. So the period of the assessment, the financial year for which the liability is being raised, that is very, very important. The year in which the liability is crystallized or the year in which the liability first demand notice has been received, that is not important. However, in case the during CIRP period there is a tax liability and the RP has made earned income, RP has paid some taxes, and in that case, in case there is any tax demand, that would be considered as a CIRP cost and would have to be paid in priority as per the CIRP, as per the priority of CIRP cost. So any operational liability which has been taken over by, which has been committed, which has been admitted by RP, it including taxes, including supply of goods or services, that is a part of the CIRP cost, and that has to be paid in full, subject to the, of course, availability of the asset. So that is paid before any other creditor is paid. So that's very, very important to understand. So we move on to some of the income tax provisions, which are very, very important for the CIRP and for the liquidation. So the first important part of the provision is Section 178 of the income tax, which provides some of the obligations on the liquidator to notify the assessing officer about the commencement of liquidation, assessing officer to notify amount due from the company to the liquidator, liquidator to take prior approval from income tax department before sale of assets. In this clause, in this section 178, it is written that this is a clause which is applicable to irrespective of anything provided in any other law. However, the insolvency and bankruptcy law is exempted. So virtually, ultimately, the meaning of this section is this section is not applicable to all those companies which are under insolvency and bankruptcy code. So no information is to be provided to assessing officer in the case of liquidation. The assessing officer will not notify any amount to the liquidator because section 178 is not applicable to those companies which are under IBC. The second very, very important section is section 46 of the Income Tax Act, which talks about capital gains on the distribution of assets by the companies in liquidation. The section provides, first of all, section 45 provides the capital gain on the sale of assets. However, immediately after section 45, the section 46 comes, where the assets of the company are distributed towards shareholders on liquidation. Such distribution shall not be regarded as the transfer by the company for the purposes of section 45. Shareholders who have received any money or assets would be taxed in their individual hands. These provisions are applicable to most of the companies undergoing voluntary liquidation under IBC also. So what is important? Whatever asset that we sell while the company is in liquidation, section 45 is not applicable. Section 45 charges the capital gain tax on the sale of assets. Section 46 they say that where the assets of the company are sold or transferred, distributed to the shareholders, in the case of a liquidation, then it is only taxable in the hands of the shareholders. See, for example, in case of a company where the assets are much more than the liabilities, and the company might be under liquidation, voluntary liquidation or liquidation, and everyone is paid, all the liabilities are paid, all the debts are paid, and still there is an amount available, and that amount will go to the shareholder. If that amount is more than the shareholders' investment, including indexing part of it, then that would be taxable in the hands of the shareholders. Otherwise, it is not taxable. The liquidator is selling the assets, giving it to the creditors. The liquidator is not making any money out of it. Even if one land which is having book value of 2 crores is sold for 20 crores or 25 crores or 50 crores, there would not be any capital gain. The capital gain would only be levied to the shareholders in case they receive any money over and above their investment. So the section 46 talks about the capital gain on distribution of assets by the companies under liquidation. So the although this section is very well there in the Income Tax Act, but it has not been so far, couldn't find many of the adjudications under IBC. Only one case was found by the NCLT New Delhi bench. I will come to that case. Now the other section is, which is the section 288, which provides for this is an amendment which is effective from 1st of April 2020, and now the RP would be provided an authority to appear before the IT authorities as authorized representative. The RP or the liquidator, so it has not been notified so far, but yes, the amendment came in this last budget and it is effective from 1st of April 2020. I think only one notification is required, and they would authorize RP and the liquidator to appear before the IT authorities, and the definition of authorized persons, authorized representative, would be changed under section 288. Section 140, which earlier with effect from 1/4/2018, there was an amendment, and it was provided that the resolution professional can also verify the return of income as the resolution professional. So since the directors or the KMPs are since the directors are suspended, so the RP was authorized to file the return after verification. See, in the last budget, with effect from 1st of April 2020, the central government has taken a power that they can prescribe other persons also for verification of the return. So the government thought that it is not really very important to go to parliament every time whenever there is a practical difficulty. So the central government has taken power, the board has taken a power from the parliament, that whenever they can even authorize any person who actually can verify the return of income. See, then like we need to see this section 56(2) subclause X of the Income Tax Act, which provides for the chargeability of the income in case of receipt of money or specified property for no or inadequate consideration. Many times when we actually try to take over an asset, maybe the shares of the corporate debtor can be transferred to RA or the nominees of the RA at 0 value or at 1% or value. In that scenario, the section 56(2) subclause X provides for the valuation process and then the taxability of the any amount which can actually become income for the acquirer. Similarly, section 50(CA) of the Income Tax Act also provides for the deeming of the fair market value of unquoted shares for computing the capital gain from the transfer of such shares. So both these provisions, the fair market value is determined based on the prescribed method. Currently, the provisions of section 56(2) subclause X are not applicable to certain specified transactions. However, no such assumption is available under section 50(C). See, this the last budget amended these sections, and the board has taken the power. In the recent budget, the board has taken the power that they will prescribe transactions or a class of person to whom this section 56(2) subsection X and 50(CA) shall not be applicable. So we expect that any transaction under the insolvency law or under a resolution plan, they will prescribe, the board will prescribe by way of a notification and then that also would be exempt. So in a resolution plan, this scenario, this difficulty would be almost over. So finally, we come to kindly let us, we want to conclude now whether the capital gain tax is applicable on the sale of assets during liquidation process or not. So the capital gain tax is applicable or not. Let's try to see the section 178, which was earlier used for recovering of the tax, that we have already seen that it is not applicable to IBC. We have also seen the section 140 where the amendment was done for the verification of the return. It was only to be verified by the RP, whereas it does not provide any return or any verification by the liquidator. So what we understand is that the Government of India, the Income Tax Department, do not expect the liquidator to file a return of income. Section 238(2) provides for a right of the liquidator to claim refunds under the Income Tax Act, because see, there are many TDS that gets deducted while we do the liquidation process, and the liquidator has a section, special section of 238(2) where the liquidator can seek refund for all the taxes deducted during the liquidation process. Section 46 provides for the capital gain, and which says that the capital gain would only be levied in case the assets are distributed to the shareholders. In case it is not distributed to the shareholders, then it is nowhere provided that the taxable, it will be taxable. On sale of the secured assets, the sale proceeds are paid to secured creditors, and the tax, if any, on the sale of the asset would be payable as a claim of the operational creditor. So this particular scenario has also been covered in the last line. On the sale of the secured asset, the sale proceeds are paid to the secured creditor, and tax, if any, on the sale of the asset would be payable as a claim of the operational creditor. So this particular aspect was also handled by, in the case of GCAB, by NCLT, the New Delhi bench. We'll come to that. We come to that section. However, we would like to conclude whether the capital gain tax is levied on the sale of assets during liquidation. So let's see, whenever we sell any of the unencumbered asset of any company which is under liquidation, the sale proceeds would be paid to the claimants as per the priority under section 53. In case funds are available, the same would be paid to the operational creditors also. In case the funds are available, the same would be paid to the operational creditors also. In case any of the assets or money is transferred to shareholders, the same would be taxable under section 46 in the hands of the shareholders and not in the hands of the company. So I think there are a lot of participants today, maybe chartered accountants, and they all understand that the return of income can be filed as a whole, and it cannot be filed for capital gain separately, income, the interest separately, or any rent separately. So there are heads of income, and there is one return that is supposed to be filed. And in the case of companies or in the case of LLPs, that return has to be filed based on a profit and loss account and a balance sheet. And it has to be an audited balance sheet, and it has to be a tax audited balance sheet also in case the turnover exceeds the prescribed limit. So in case the financial statements are not made, in case the auditing is not done, in case the tax auditing is not done if applicable, then no return of income can be filed, because there is no process under the Income Tax Act to declare capital gain separately, interest separately, rent separately. So unless the financial statements are prepared, no income tax return can be filed, and no tax can be paid without filing an income tax return. Regulation 15 of the IBBI liquidation process provides that the liquidator is required to maintain and get the auditing done for receipt and payment account of the liquidator. A receipt and payment account is not profit and loss account. It is not a balance sheet. It would not provide me book profit. It would not provide me any expenditures or deductibles or deductions. It is only a receipt and payment account. And the auditing of the financial statements are not required during liquidation process. Nowhere it is provided in the Companies Act, nowhere it is provided in the Insolvency and Bankruptcy Code or the regulations that the liquidator is required to prepare audited balance sheet of the company. Even if the company is continuing as a going concern, the liquidation order is very, very important. Even if the company is continuing as a going concern, the liquidation, the financial statements are not provided under the code so far. It may be provided in future, I'm not sure, but so far it is not provided. So this is one case which is having a caption like Miss Pooja Bari versus G Ispat Private Limited, NCLT New Delhi bench. Income Tax Department claimed that the capital gain tax should be deposited first as per the Income Tax Act. It was held that the liquidated assets are those released by the secured creditor under the code, means the secured creditors only relinquished the assets in favor of the liquidation estate and the liquidators sold the assets. It was also mentioned in that order that the secured creditors is not paying any capital gain tax in case they sell the asset under the SARFAESI Act. Then finally it was held that the tax liability arising of the sale of assets shall be distributed in accordance with the provisions of section 53 of the code. So in this case, in case the asset was sold for 20 crores and the cost was 2 crores, so the after taking even the indexing cost, it was 5 crores, the index cost is the 5 crore. 20 minus 5, 15 crore is the total amount of capital gain tax, and on 15 crore, if there is a tax liability of say 3 crores, that 3 crore also would be considered as an operational debt. That 3 crore also would be paid in case the amount is available under section 53 for operational creditors. So therefore, we actually have to conclude that if the liquidation value is not available for operational creditors, then the tax is also not payable. The tax is also payable only in case the assets are available to that extent that it covers everyone under section 53 and still the assets are available for operational creditors. So coming on to GST on the sale of goods or capital assets under the liquidation. This is referred in Schedule 2 of CGST Act, paragraph 4A, and it is mentioned there that the goods forming part of the assets of a business are transferred or disposed of by or under the directions of the persons carrying on the business, and the assets would no longer to form part of these assets. So these are the three conditions. The transaction is done for consideration or without consideration. Input tax credit has been availed on those goods or not. Goods belongs to the pre-GST era or post-GST era, GST is applicable. Whether the transaction involves consideration or not, transaction is without any consideration, if the transaction is intentional or if the transaction is unintentional, all these conditions has got no meaning. GST is applicable on the sale of capital goods under liquidation. Where the input tax credit has not been availed on the capital goods, where the ITC has been availed on the capital goods, the value of the supply has to be determined. So the entire GST law is applicable on the sale of capital goods, and there are different scenarios under GST. In case the input tax credit has been availed, then in case you sell the asset, then there is a different way of calculation of the GST payable. So in case it is a pre-GST, there is a era purchase, then the different process. Post-GST era is a different process. So in case the transaction is done without consideration, then there is a process of valuation and valuing the transaction. If the transaction is intentional or transaction is unintentional, there is a separate scenario. So the entire GST is applicable on the sale of capital goods or the sale of stocks or anything which is attracting GST during liquidation process. So what is not taxable? One thing is not taxable under GST, that is GST on sale of business or part business as a going concern. So this was also provided in the notification number 12/2017 by the Ministry of Finance, and it was dated 28th June 2017. In the notification, it was said that this service by way of transfer of a going concern as a whole or an independent part thereof in serial number 2 of the said notification to constitute under supply of service. So first of all, they said that this is a service, this is a supply of service. Further, the activity of transfer of a going concern shall have nil rate of tax on such supply. So the conditions are transfer of business assets supply of goods, and it is taxable. Transfer of business, it will be considered as a supply of goods, supply of service, supply of goods, and it will be taxable. Then is the transfer of business or part thereof as a going concern. It will be considered as a supply of service, and it will be exempt via notification. So only thing which is exempt is the supply of service by way of a transfer of an asset or transfer of a business as a going concern. This also, because we also could get hold of one ruling of the advanced the authority in Karnataka, that is in the case of Rajshri Foods Private Limited, and the advanced ruling was on dated of 23rd of April 2018, and the above view was upheld, and it was upheld that the GST is not applicable when the sale of the business or a part of the business is done on a going concern. So, Ankit, is there any question on this part? Because then I think in the next part would be, I have to take it quickly because the time is already up and the subject is still a lot of subject is left.
So I think I can. There are not many questions with respect to GST per se, and with respect to income tax also. I asked the questions to you. There are a few questions on whether TDS. How will TDS apply when the properties are sold by the liquidator during the liquidation process? So some people are saying that the purchasers of those properties deduct 1% tax under the TDS provisions of the country. What is the way out for that, and what is the applicability of that TDS, and if that TDS is required to be deducted, how do they claim it back? So that is a question coming in. That's more of an operational question. Maybe you can answer that one.
No, I think see, I said that the TDS provisions would be applicable, and in case the RP can file an application to the assessing officer, explain all the conditions of the liquidation, and take a certificate that the TDS should not be applicable on this, so that of course can be avoided. Otherwise, after the TDS is deducted, as I said, that there is a section which actually helps the liquidator, section 238(2), which provides the right to the liquidator to claim refunds. Section 238(2) of the Income Tax Act provides that the liquidator can claim the refunds. However, in case the application can be filed for low deduction or for no deduction of TDS,
so that application under 197. So that application under 197 should be the first course of action then. Yes, and if that is not possible, then it can be this second
section
option.
238 subsection 2.
Perfect. Maybe you can continue.
So the TDS and TCS provisions during CIRP and liquidation process is all applicable. All TDS provisions are applicable during CIRP. Resolution professional is under obligations to comply with TDS and TCS provisions. Liquidator is also required to comply during the liquidation process. A liquidator is entitled to claim any refund of any TDS deducted for any corporate debtor while selling some assets under section 238(2). So here is the question answered in this slide itself. So the one scenario, because I will actually do a little quickly, and I will also seek permission from the participants that in case it is extended by another 15 minutes, so I think they won't mind. So in case they, because this next part is the restructuring of a resolution plan, which might even take longer period. See, one that I wanted to discuss is the section 179, liability of the directors of a private company in liquidation. The tax dues of a company under liquidation can be recovered from the directors if the dues cannot be recovered from the company. But then the second part is very, very important. The directors fails to prove that non-recovery of tax dues is not because of his gross neglect, misfeasance, or breach of duty. So the department, the income tax department can also seek information from you whenever they actually get awareness about it. They can also get information from you whether there is any fraud application or negligence applications or misfeasance applications has been filed by the RP, or whether there is any order in that case. In case so, then the income tax department can also recover all the tax dues from the directors in a case of a private company. So they can even come to you, because see, the moment the awareness will spread around, they would actually come to the RPs to take this information of fraud, neglect, and misfeasance, or the breach of duty. In that case, the directors will have to be the tax liability can be recovered from the directors. So similar law is applicable in the case of partners of the limited liability partnership, and that is provided in section 179 of the Income Tax Act, the 167C of the Income Tax Act. It is similar to 179. Section 140, we have already said that the RP has already been prescribed as the person who can verify the return of income. There is no provision so far for the liquidator, so that we believe that the liquidator is not supposed to file any return of income. Amendment, which is dated 1st of April 2000, with effect from 1st April 2020, has empowered CBDT to prescribe for any other person for verification of return. Now, this is this part is which is very, very important, is that when we prepare a resolution plan, then we normally should prepare something which is called a pre-approval balance sheet and post-approval balance sheet. So in case we prepare something which is a post-approval balance sheet, I think when I touching this part, I should actually come to that illustration that I prepared. Maybe it is visible to you or not. I will see that it is visible. So this illustration should be seen. I am not able to like enlarge it further. The only thing is that this is the exercise that everyone should do: pre-takeover liabilities and post-takeover liabilities. Then comparison between the two and arriving at the profit in books. Then arriving at the taxable income. Then we can say how much tax is levied, and if tax is levied to a great extent or to very, very high, and that actually would disturb the implementation of a resolution plan. Now I am touching this part, which is the implementation of the resolution plan. While implementing, in case there is a waiver of liability, there is a remission and rescission of the liabilities under section 41(2), that would become income, or under section 28 of the Income Tax Act, that can become income. So we should always prepare this kind of a chart: pre-takeover balance sheet, post-takeover balance sheet, profit in books, taxable income, and then finally, in case we can handle it by way of some assignment or by way of any other method. So coming back to the, actually while handling this illustration, I will again come back to the relevant provisions. The relevant provisions of the income tax starts from section 41, subsection 1 of the Income Tax Act, where an allowance or deduction has been made in the assessment for any year. That means that where any expenditure has been allowed, any loss has been allowed, or any trading liability has been incurred by the assessee and it has been allowed in the past, and subsequently that liability has not been is not payable, there is a remission in the liability or there is a cessation in the liability, that would become taxable in the hands of the company. That would be taxable in the hands of the company, because this whatever allowance was given, that is now recovered by the company, as that is not payable, so that will be taxable. So what is very, very important to understand is that in case I have incurred any expenditure, and by incurring an expenditure I have created a liability. For example, that I have received an invoice of chartered accountant for the audit, 3 lakhs of rupees. So I booked an expenditure and the amount is payable. Now after the insolvency, that amount may not be payable because that amount would be zero. So the 3 lakhs of rupees will become my income. Similarly, if I'm providing for the interest on the loans, I'm providing for the interest on the loans, and the interest is allowed from the income tax department, and finally that is not paid by me, of course, like subject to section 43B. If it is not paid by me, that also will become my income. So in case I purchase some goods, and also I purchase the goods after taking working capital loan from the banks. So when I take working capital loan from the banks and I purchase the goods, that means that purchase is funded by the bank, and after that the liability to the bank is not payable, whereas the purchase of the stock has already been allowed to me as an expenditure if it is not built up in the closing stock. Then that liability also would be considered as a profit in case it is waived. So these are some of the examples. Similarly, section 28 subclause 4 of the Income Tax Act says that the value of any benefits or perquisites, whether convertible into money or not, arising from the business or the exercise of a profession, that also is taxable. So when in a resolution plan, we actually have to find what is taxable under section 41 subsection 1 and what is taxable under section 28 subsection 4. So this is the Delhi High Court judgment. In fact, I should go to the Supreme Court judgment first, which is the Commissioner versus Mahindra and Mahindra Limited, where it is held would be taxed the profit under section 41 subsection 1 and 28 subsection 4 would be taxed as business income, and following deductions are allowed from business loss. Loss on sale of assets on which depreciation is claimed by the assessee, write-off of non-recoverable current assets, that is sundry receivables, advances, etc. Loss of stock can be claimed as business loss. Brought forward, these are brought forward business loss can be set off against the business profit, and VAT is also not applicable up to the amount of brought forward losses. However, the future depreciation would be reduced as any remission or cessation of the liability which is raised for the investment of the creditor. Then coming to this, the Logitronic Private Limited versus Commissioner of Income Tax is the Delhi High Court judgment in 2011. It has been held that any amount which has not been claimed as deduction before by the assessee, the write back would not be taxable. Loss, expenditure, or trading liability incurred by the assessee and later write off would become income. Liability incurred for any other purpose and later written off would not be an income for the assessee or successor in business. Liability incurred for acquisition of capital assets and later waived and written off does not qualify for tax under section 41 or 28(4). So there was another case of Madras High Court, the CIT versus Ramaniam Homes Private Limited. This judgment is again on remission of loans taken for capital purposes. If the waiver includes outstanding interest which has been claimed as a deduction in earlier years, or loans obtained for the purpose of businesses, then such waiver may continue to be subject to tax in the hands of the borrower as ruled by the Madras High Court. Impact under MAT provisions. The other issue is to determine whether the loan waived should result in MAT implications, which would depend on the exact accounting for the write backs. So when we talk about section 115JB, which means that the minimum alternate tax, that also would depend upon the accounting policies adopted by the corporate debtor in the past. Now, the applicability of section 115JB, which is provision of payment of minimum alternate tax. In most of the resolution plans, this will appear as book profit. However, there was an amendment made. In 2018, and this section 115JB, what was allowed for the companies under the Insolvency and Bankruptcy Code, where a resolution plan is approved, then in that case, the entire unabsorbed depreciation and the entire loss brought forward would be allowed in 1 year after the resolution plan is approved. So that amendment has given some relief to this taxation implication. This last budget has also added, because this earlier amendment was only under the Insolvency and Bankruptcy Code. However, in the last budget, any company which actually is going through the NCLT resolution process, where the process is initiated under section 241 of the Companies Act, where the central government initiate the proceedings, in those cases also this benefit would be available. So section 79 of the Income Tax Act also provides that in case all the shares or more than 51% shares of a company is transferred in a year, so the brought forward losses would not be available. So under this resolution plans, in most of the companies, the company would be transferred to the resolution applicant or its nominees. Most of the capital would be transferred. Substantial part of the capital would be transferred, and the section 79, if applied, the brought forward losses would not be available, and the company would end up into a lot of profit and a lot of taxation. So this amendment was with effect from 1st April 2018, and the section 79 was made not applicable to all those companies which was taken over as a resolution plan duly approved by the NCLT under IBC. So this exemption also would provide some relief, and in the last budget with effect from 1st April 2020, this exemption is also extended to those companies where the central government initiates insolvency process under section 241 of the Companies Act. Now coming to the structuring of the resolution plan, so we have seen now, let us reiterate what we have seen. One, that any waiver of the liability, wherever it has already been allowed as an expenditure, as a loss, or as a trading liability, if waived, would be taxable. Secondly, whatever liabilities are reduced, even if on account of capital goods, even if on account of term loans, that would actually become part of the book profit, subject to taxation under section 115JB, that means minimum alternate tax. Third, if all these taxes payable after the resolution plan is approved, the brought forward taxes or the depreciation can actually provide a bigger relief, so that the implementation of the resolution plan or the RA should not be liable to pay tax on all the waivers that he has got approved from NCLT. So in various cases, even after doing all this, like maybe in this example itself, if you see this illustration, the profit in books is showing as 610. Taxable income, after considering all the exemptions available under section 41(2), is 385. So it is still taxable. 610 is taxable under section 115JB. So I have even seen the brought forward losses, which is 100 as per the income tax, and as per the brought forward losses as per the books is 400. So still it is taxable. So under 115JB also I'm paying tax, and also the company is paying tax on the taxable income. So because the profit in this case is higher, and there is a possibility of a lot of tax liability. So what are the options available in such cases?
So one question that is, why is the working capital loan taxable, and some people are of the opinion that it should not be taxable. So maybe we can address that working capital loan question.
Now see, the working capital loans, like let us take an example of that I purchased 100 crores of coal. And I purchased it by taking a working capital loan from the bank, and the coal is in my stock. And the loan is appearing in my balance sheet. So that means that the coal is there in stock, and I have not even availed any benefit from the income tax department. I have not claimed any expenditure. It is still there in my balance sheet. It has never shown as an expenditure. It shows an expenditure only if the stock is consumed. If the stock is consumed but the loan is not paid, then it becomes a waiver of the working capital, because it has been already allowed as an expenditure. Then in case the working capital loan is waived, it becomes taxable. However, in case the stock is still there in my balance sheet and the liability is still there, that means it has never been allowed as an expenditure. So in case I get a waiver for this part, it has never been allowed as an expenditure. So if it is not been allowed by the income tax department as an expenditure, it cannot be taxed under section 41(2). In case the stock is consumed, then it is allowed as an expenditure. Then in case I get a waiver of the working capital loan, then it is the taxable, because that is allowed. After the allowed, it is not taxable. If it is not allowed, it is taxable. So it has to be, there is no concept of working capital. Working capital is taxable, and working capital loan waiver is taxable or not. It doesn't depend upon what is the nature of the loan. It depends upon how and when it was allowed as an expenditure or as a loss or as a trading liability to the assessee company, then only it will become a case of whether it is taxable or not. Simply by just naming it as a working capital loan, it would serve no purpose. It has to be seen when was this expenditure allowed in the past. If it was not allowed, then it is not taxable. Any other question, Ankit, on this?
Some questions are coming in for Matt. So Matt, credit that is available with the company, and say the company has a tax liability post the resolution plan or because of the resolution plan under normal circumstances. So the question is, can Matt credit be available and can it be deducted from the tax liability coming in from normal provisions?
For the tax liability, actually, as far as the MAT is concerned, like my whenever I get waiver of various liabilities, it actually has to be routed through the uh, profit and loss account. At times, there are discussions available in the market, and there are some professionals, they are saying that there is a possibility that we can adopt some kind of accounting policy that the such kind of waivers of the capital goods or capital loans should not be routed through the profit and loss account. So for the time being, that particular strategy, that particular theory we are keeping aside. We are only saying that whatever is being waived, it is routed through the profit and loss account, and there would be a book profit. Out of this book profit, the entire past book loss and the unabsorbed depreciation would be allowed to be adjusted in the very first year. And in case still there is a MAT, the tax has to be paid, or alternatively, we have to structure the resolution plan in a different manner.
So I think you're right that normally you will find a MAT liability coming in rather than the tax liability coming in and the MAT not leading to a taxation. So that would be the normal scenario. But maybe the MAT credit availability for the pre-CIRP period will be subject to of course the approval of the resolution plan and the allowability by the income tax department for us for the resolution applicant to take forward that MAT credit.
So I think now the very, very important part is, because I'm actually conscious about the timing, maybe that the participant may have to go and may have to adjust their timing accordingly. So the first possibility is that instead of, in case still we are paying a liability, in case we are still incurring a liability to pay taxes, I don't think any resolution plan the RA would be able to submit a resolution plan where some tax liability is there, and that has to be planned. So this is the duty of the RA, and this is the duty of even the consultant who is working with the RA to see what kind of structure is required for a resolution plan. Let us see the first option. The first option is that in case the minimum alternate tax is payable, or the otherwise the waivers are subject to some tax, then we can even ask the committee of creditors that we would like to convert some of the debt into the shares. We can ask this committee of creditors that we would like to convert some of the debt into the shares, and then we will acquire that shares from the creditors. So this part is that the bankers, the lenders will convert some part of the debt into the into shares, and those shares will be acquired by the resolution applicant, and then the later on, subject to the, because in case the shares are acquired, then in that case also somehow the assets and liabilities has to match. In case there is no matching asset on the other side, then the capital has to be reduced. So this is a little complicated, because the lenders, I haven't seen any case where the lenders have agreed for conversion of debt first into the equity, then transferring the equity to the RA at a zero value, or at a kind of symbolic value, and then RA reducing the share capital. So this is a little complicated. However, this is a scenario, because the conversion of debt into equity is not something which invites any kind of taxation. When the shares are acquired from the those shares would be definitely the section 58 and 50 CAC would be applicable, and we are expecting kind of relaxation in that, as in the last budget that we have seen. The CBDT would notify, or even the central government may notify what kind of transactions would not be considered as taxable under section 58 and under section 50 AC. So this part is also possible to do, but then I haven't seen the bankers very eager to take this as an option. In some of the cases, like the section 115BA or section 115BAAB is 115BAB has also been discussed, but this also could not give any relief uh, from the taxability of the waivers. And this is only in those cases where there is no other option. When there is no other option of restructuring or structuring, then definitely somebody can say instead of paying 30%, we should pay 22%. Then only these are the options available for the part. See, the very, very important and very, very practical part of the option, very, very practical option is available is that in case there is still a possibility of still some taxes payable under MAT or some taxes payable under the taxable income part of it, then we can ask the lenders that we will take the assignment of debt. The resolution applicant will take the assignment of debt from all or some of the lenders at some value, and that value would be a value which will optimize the MAT and taxable part of the income, and that debt in the balance sheet, in the post approval balance sheet, that debt will stand as such, but that would be assigned to resolution applicant or any of the nominee of the resolution applicant. In various resolution plans that we have worked on, we have seen that the resolution applicants are more interested in this option of structuring, because they would actually they would nominate one of the very closely held company of their family as the company to take the assignment of the debt, and then they would actually use the future profits of the corporate debtor to repay that debt, also to save taxes, and also to kind of take out money out of the profit of the corporate debtor after revival. So the most preferred scenario and the structuring of the resolution plan in case the tax is payable would become the assignment of debt. See, the other part, this is something that we are trying to tell, something which is the first part of the planning is that we see the asset side also. In case we find any asset, like in case we are incurring a tax liability under MAT or normal, then we should see the asset side of the balance sheet. In case there are some assets which were not seen in the valuation report, but which was there in the fixed asset register, that can be written off. When we write off those assets, in any case the book profit would be reduced. Further, in case we have some stocks in the balance sheet which was not found in the valuation report or which was not found physically available at the site, that also can be written off based on the valuation report. In case we have some receivables, some sundry debtors, some advances, or some claims which we crystallize during CIRP period, or we feel that it is not even recoverable, then we can even write off or we can even provide for the bad debts. So in future, in case those are recovered, that can be claimed as, that can be declared as income. But for the time being, to reduce our MAT liability and a normal tax liability, we can even write off those debtors and advances. And so these are the first scenario planning, adjusting the assets and the liabilities in a manner that both the liabilities and the assets are coinciding and they matches with each other. So in case still there is a tax liability, then we can talk about the assignment. In case still there is a liability, we can even talk about the conversion of debt into equity and then transfer of the equity to the RA and then reduction in the equity. All would depend upon the scenario, like waiver, the assets, amount of liabilities, amount of assets not found. All this will depend upon the facts of the case. And finally, a combination of all these structures is also possible. Partly assignment, partly conversion, partly the planning from the asset side. All this can be done in that manner. So this I have already discussed, like the asset side. Investments can also be brought to the real market value, and the losses can be booked depending upon the accounting policy of the corporate debtor. All these book losses book losses, as I said, will depend upon the so this illustration. So in case you see this last column, where I proposed that 285 crores of the debt would be assigned to the nominee of the RA. So in case this debt is assigned, so the reduction or waiver or the reduction in the liability would be reduced to the extent of 285. My taxable income would be nil, and my book profit also would be not taxable. So this illustration, I have proposed assignment so that the tax liability is taken care of. See, we also need to handle various other queries which I have been receiving on various seminars, that is regarding various kinds of assessments. So the first part would be the tax liability which is not crystallized. So how to handle the tax liabilities which are not crystallized? Assessment, reassessment notice received during CIRP period for pre-CIRP period. So assessment, reassessment notice received during CIRP period for pre-CIRP period. Proceedings would be kept in abeyance, or we can handle the proceedings as per the information available. Continuation of the proceedings will also be we can even continue the proceedings, or we can even suspend the proceedings based depending upon the information available. The proceedings can be resumed whenever we feel that the information is available, or during liquidation it has to be resumed. Tax authorities would be intimated that the CD is under CIRP and the tax proceedings need to be kept in abeyance. So all this scenario, when the moratorium is lifted, then after the CIRP period, when the entire resolution plan is approved, then this part can be handled through the monitoring agency. Then the monitoring agency can reply to the tax department that all these taxes, whatever has been raised, pertains to the period which is pre-CIRP period, and for the pre-CIRP period, the liquidation value was not due to the tax authorities. This is income. This is my information memorandum, which actually provides you the details of the debt. This is my liquidation value based on the valuer's report, and this is my resolution plan. All the three documents can be submitted, and then it can be told to them that there is no money which was payable to you for any period which is a pre-CIRP period, and that liability would be considered as not payable under the code. So this is the way we actually have to handle. The only part is practical part. A practical part is that yes, the resolution applicant or the monitoring agency has to go to the tax officers, provide them the information, and make them understand that this is not payable. This is not payable because the liquidation value was not payable to you. The liquidation value was not even sufficient for the secured creditor, even or other creditors. Assessment, reassessment notice received post CIRP period for the period when the CD was under CIRP period. So the RP shall be responsible for complying with the requirement under any law for the time being. This is section 17(2) subsection E. The proceedings will have to be attended by the liquidator or monitoring agency, and all the information will have to be provided because this pertains to CIRP period. Any tax levied will have to be paid by the liquidator or the resolution applicant, and would be considered as CIRP cost. Now the question comes is the assessment, reassessment notice received post CIRP period for the period when the CD was under CIRP, like the same thing. Again, any penalty, any other penal charges. So all this scenario is basically dwelling on one thing, whether this amount was payable, tax dues was payable or not, as per the liquidation value. So for example, as I said, that in case the resolution plan is offering much more than the liabilities, then the tax dues would be payable, and there is no possibility that those tax dues can be waived. So there are scenarios, even I have few companies where we actually had we had even distributed some amount to the shareholders. So there it has to be paid in case there is any demand. So there is no possibility of a waiver in case the liquidation value is enough for the payment of the operational creditors. So in lump sum, if the notice is received after the CIRP period, during the CIRP period, or before the CIRP period, the year of demand is very, very important. If it pertains to a period which is pre-CIRP period, it has to be claim filed, it has to be claim admitted, it has to be amount distributed as per section 53. Then if it is for the period of CIRP, if there is a tax demand, that has to be completely assessed, information provided to the assessing officer, whatever the tax due for that particular period would actually become the CIRP cost, irrespective whether the liability is crystallized or not. If the liability has been crystallized or not crystallized, contingent or it is so the scenario is the same in all cases. So in case the liability is crystallized, definitely it will be handled as per the section 53. If the liability is not crystallized, the RP or the liquidator will have to attend the assessment process, assessment proceedings, and that would depend upon the uh, seriousness of the assessment proceedings. If the value of the assets are much more, then the seriousness is very high. Then the RP should attend the case and provide all the information. If the seriousness of the case is very low, that means that the liquidation value is very low as compared to the debt of the company, then it can be told that I have no information, so the assessment can be concluded on merits. The department will conclude the assessment on merits and then later on will write that off because of the no liquidation value available for payment of operational creditors. So all this basically comes to the same scenario whether the appeal is pending or appeal is not pending. Appeal is pending, you actually have to handle it in the same manner as if the assessment order in relation to search and survey. See, even search cases also, I would actually see one or two examples. I would say in the search cases, if the asset is attached by the department and has not been appropriated for towards the tax, then that asset will also come to the RP or the liquidator, because after the CIRP, any asset which is in the name of the company cannot be sold, cannot be attached, cannot remain even attached. The same treatment as explained, demand notice, reassessment, everything actually, the only issue is attachment and detachment. Any appeal pending anywhere, that also would go through the same process. The year of the assessment is the year of the tax demand is very, very important. See, the one part that I want to discuss here is the dispute related to matter appeal. Appeal proceedings need to be attended. Matter can be decided by the tax authorities based on the liquidation value due to tax authorities as an operational creditor. Tax demand can be crystallized and then recoverability can be decided by the tax authorities based on the liquidation value. Appeal can be summarily closed by the tax authorities depending upon the information submitted to them about the liquidation value. They can even decide that there is nothing which is possible to be recovered, so the appeal can be decided without even applying much mind. Claim of refund. Claim of refund cannot be considered an asset of the corporate debtor unless claim is accepted and crystallized by the tax authorities. Tax deposited under protest would be appropriated against tax demands if for the same period, otherwise it would be refundable. Now section 245 of the income tax provides for set-off of refund due against tax demand by tax authority. So section 245 provides for the set-off of the refund due against the tax demand by the tax authorities, and section 36(4) of the IBC. The following shall not be included in the liquidation estate assets and shall not be used for recovery in the liquidation. Any other asset as may be specified by the board, including assets which including assets which could be subject to set off on account of mutual dealings between the corporate debtor and any creditor. So a combination of section 245, this is very important, participants, please be aware. Section 245 of the income tax and section 36 subsection 4 of the IBC collectively says that that the income tax department has a right to set off the refund against the tax demands. On the other hand, section 36(4) says that the following shall not be included in the liquidation estate: any asset as may be specified by the board, including assets which could be subject to set off. So that means that the income tax department has a right under the Income Tax Act or as the IBC to set off refunds with the demands. So that I wanted to crystallize. The pending assessment of court recovery matters, the disputes related to the matter appealed, all has the same scenario. It depends upon whether this can be payable to them or not as per the liquidation value. So one question was being asked to me, like, can IBC become a hindrance in income tax recovery mechanism under Section 220 of the Income Tax Act? Yes, IBC can become a hindrance in recovery of tax, as the assessee can take shelter and protection of IBC and use moratorium for to find a resolution of the tax dues. The second question, which actually used to come, IBC as a vehicle of tax liability avoidance by MSME. MSME can plan an insolvency for finding a rescue from tax authorities, as they can file a resolution plan seeking relief from the tax authorities based on the low liquidation value. The other question which is being asked is whether the CIRP cost is allowed as an expenditure under Income Tax Act. Yes, CIRP cost is an expenditure for carrying of business and would be an expenditure allowed under Section 37 of the Income Tax Act. This judgment we have already considered synergy dure, and Swiss ribbon also is a judgment which defines about the operational creditor, operational debt. This is one judgment which is in my case RMS Employees Welfare Trust versus Anil Goel, where NCLAT has said I'm reading the bold part, the debt of the central government or state government arising out of the existing law being operational debt, the question of asking for waiver does not arise. The question of asking for waiver does not arise as per the resolution applicant to decide how much to be paid to the central government or to the central government against the operational debt, which should not be less than the amount to be paid to the operational creditors in the event of a liquidation of the corporate debtor under Section 53. So the NCLAT said that there is, in this case, while the resolution plan was being approved by NCLT Chandigarh bench, the paragraph written in the resolution plan order, approval order was, we find that the para C4 of the minutes of the meeting COC held on such and such, it is inter alia stated that no payment under the resolution plan is envisaged for government dues. The matter related to the waiver of the government dues, including waiver of MAT liability under Section 115J of the Income Tax Act 1961, may be considered by the respective government department. So this was the paragraph written. So it disturbed the resolution applicant. Then the resolution applicant, who was RMS Employee Welfare Trust, filed an appeal before the NCLAT, and NCLAT in fact said that this paragraph, the part of the impugned order dated 14 September 2018 as quoted above, is set aside. The rest part of the impugned order approving the resolution plan is upheld. So in this case, while the bench said that you actually have to go to the respective government departments, NCLAT said that there is no need to go to the respective departments in case, and there is no need to ask for the waivers. In case anything is payable to the operational creditors under Section 53, it would be paid. In case it is not payable, it would not be paid. I think to my scenario, it is over. I can take up some of the questions. Ankit, if the time is already, so we have taken 20 minutes.
We have exceeded the time. What we will do is I'm putting the lowering the hands of all the participants who had raised their hands right now, and I can unmute some of the participants who have a question. My request is that the questions may please be specific to statutory liabilities and not generic to overall IBC, so that all participants can derive something out of it. I'm just unmuting Mr. Ramela Rangaswamy. So maybe you can unmute. You're unmuted, sir.
Yes, Mr. Ramela, what is your question?
Hello. Sir, I
Yeah, you're
already
audible,
posted
sir.
and I got answer for my query from your speech, sir.
Okay, good, very
Okay.
good. Thank you. See if you got the
Thank you,
answer.
thank you, thank you. So I will again lower all the hands. I will request those participants who have not got their answers to perhaps raise their hands. So I am unmuting Mr. Surendra Devasani.
Yes, Mr. Surinder, I can hear you in case you speak.
Hello.
Yes, sir.
Yes, please.
See, in one case, TDS is deducted by employer who is now CD, and it is not deposited with the tax authorities. Now the TDS amount is claimed by the employees. How to treat this TDS claim, sir?
See, I think we have in the past, we have the case of Kingfisher Airlines when the lot of TDS was deducted by the Kingfisher Airlines and it was not deposited.
Yes.
There was an order by the authorities of the income tax department that this particular credit would be given to the employees. However, the collection and the recovery of the TDS amount from the corporate debtor is the responsibility of the income tax department, and that should be uh, collected and recovered by the income tax department. So in case it is not recovered by them, so they will write it off. However, the employees will get the credit in case they have the evidences that the TDS was deducted on the salary. So they will have to take up the matter on the from the income tax department. However, it cannot be considered that this particular part of the amount would be held as a amount held as trustee or something like that. That has not been seen in any of the judicial pronouncements. So far, not been seen. Although
Can
there is
the
a
can the
although there
can
is a
the
view.
employee make a claim of this non-payment of TDS from the CD?
So the employee can also make a claim, and in the meantime, the employee also should make a claim before the tax authorities that I have the evidences and it was deducted. However, the TDS certificate is not being given to me and neither the tax is being deposited. So I should be given a credit. So there are various judgments where in case the tax is deducted and is not deposited by the deductor, then the benefit can be given to the service provider or the supplier of the goods.
I am now unmuting. I hope your question is answered, sir. I'm now unmuting Mr.
Yes, sir.
Kapil Maheshwari. Mr. Kapil Maheshwari, I think I have unmuted you. You have to unmute yourself.
Hello.
Yes, sir.
Yes.
Hi. Thanks for the session, sir. Sir, my question is when a demand notice by a tax authority comes, so that demand notice typically adjusted of the already deducted TDS. Now, under a resolution plan, I, as an operational creditor, when I'm providing for income for tax authorities, I have to provide for the entire amount because the demand is already adjusted for TDS. So I shall provide for the entire amount, and if there is a claim TDS refund which is possible, we can get that TDS refund also in that sense.
Now, one thing I said that as per section 245 of the Income Tax Act and then as per section 36(4) of the code, the Income Tax Department has a right to adjust a refund with the demands. And because these two things provide them a right to set off within the same organization. If ABC and company has a refund and ABC and company has a demand also, so they have a right to adjust the refund with the demand. So as far as this considering the TDS refund separate and demand separate would not be possible. This is what I could understand. Ankit, could you understand differently the question?
So is that under a liquidation scenario? So under a liquidation scenario, the adjustment would happen, but under a resolution scenario?
Even in the resolution scenario, also the Income Tax Department has a power to adjust under section 245 of the Income Tax Act. They have a power to set off the refund and the demand. But then the demand must be payable. The demand should be completely raised demand, and it should not be stayed. It should be payable.
So I think that's what I think we also mentioned in the during the sessions, that demands and refunds of income tax and other authorities can add a lot of value to the whole resolution process. So I am now unmuting Mr. Harjeet Rekhi.
Yes, Mr. Rekhi.
No, I think my bad. This screen is moving too fast. Just give me a second.
Sale of a
yeah. Yes, please proceed.
Is GST or CGST applicable in UP for sale of a rice selling unit? And this is in liquidation. The company is in liquidation. And what is the rate of GST or CGST payable?
See, the one part I already said in my complete webinar today, that there are two scenarios. One, that the sale of assets or group of assets during liquidation would attract GST at the appropriate rate. So what is the rate on plant and machinery? What is the rate on rice stock? That of course you have to see what exactly is the rate. I don't remember the rate on the rice and machinery. But in case you sell the rice factory, as a going concern, then the GST is not payable. In case you sell
it is
the
not a
rice
running
factory,
unit. It is not a running unit.
going concern.
I'm sorry, I just accidentally muted you, so you will have to repeat that last part.
So I said the definition of sale as a going concern would not really mean that the corporate debtor should have continued operations. Even if the operations are stopped, even then it can be said that it is a unit which is being sold as a going concern. That means that all the assets are being transferred to someone without even showing separate value for the assets, and the company is also going along. So that's a company is going as a going is being sold as a going concern. Even some part of the business can also be sold as a going concern, even if the entire company is not being sold, but then some part of the business, one part of the business can be sold as a going concern, then also GST is not applicable. However, in case this rice is being sold separately, plant is being sold separately, then GST is applicable.
So I am allowing.
It is already 2:30, so maybe that we can take one more question.
Yeah, I am taking one last question from Mr. Maniram Bishnoi, and yes, so you're unmuted. Mr. Aniram Bishnoi, you're unmuted. Maybe there is a problem in the connection at his end. I can now take Mr. Raj Singhania.
Yes, Mr. Singhania, if you can.
Yeah, Anilji, my
Yes,
query is with regard to PF dues, like what you have said, that in case there is no payment of salary, PF dues will not be there.
No,
But in case
PF
of
dues becomes dues. Yes, please.
But in case suppose there is a non-payment of salary for the last 2 years in case of a CIRP before the CIRP
Right.
commencement date,
Right.
what will be the situation of the employer's contribution as well as employee contribution?
So if no salary or wages are paid, then there is no question of PF dues also. The PF becomes due when you pay the salary, you disburse the salary, deduct employee's contribution, and then it has to be paid along with the employer contribution. If no salary is paid, if no wages are paid, then it actually will be considered as everything is deferred. So whenever you pay salary, whenever you pay wages later on, at that time, the PF and the PF would be applicable.
Yes, so that means the employees will claim their gross salary, but the PF authorities cannot claim even the employer's contribution.
No, PF authorities only claim based on the returns filed by the or based on the salaries paid, or based on the information available with them. So in case there is
no returns were being filed,
then there is no possibility of any demand coming from the PF department. PF demand only comes on the disbursement of wages and salaries.
Okay, and for the employee part, they can claim as their gross salary because nothing is being deducted.
They have to claim their gross salary only, because see, the deduction and all that only happens when the disbursement is made.
Okay, thank you, sir, for clarification.
So there are many other questions, and some people are also making requests on the question panel for to allow them to raise their question. And I think because of
I just want to address, in case there are bankers or there are NBFCs as a participant in this webinar. So the next webinar that we are going to start at 4 o'clock today, that would be in fact very, very useful for all those bankers or all those NBFCs who are engaged in recovery through SARFAESI. See, the SARFAESI Act has also seen a lot of amendments, and we have compiled all those amendments, and we have compiled our experience of since 2003. The banks have already given us more than 27,000 cases under SARFAESI Act for enforcement of security interest. So our experience is completely presented today at about 4 o'clock today as per the webinar. I would request all the bankers that they should spread this to their teams, and this would be very useful. And maybe because of this webinar, the recovery under SARFAESI would become faster than before, because this actually would I have somehow added the entire my experience of 27,000 cases, and my team, which is presently 190 employees, they have all contributed for this webinar content.
I will also repeat that I have already posted the link for this webinar in the chat box, and that is posted to the entire audience. So all of you will be able to find this link in the chat box. If there is, so yeah, I don't think there should be any problem doing that.
So I can see that even if we have exceeded our time, about 500 people are still connected with us. And I'm really thankful to the participants for the kind of interest they are showing in this webinar. And I would also try to take the questions in case I'm not able to attend today. Maybe that we come up again, and all these questions that will form part of my future PPTs, future presentations. So these, as I always say, that one question asked from me by any of the participant or any of the attendees, that actually would be adding to my knowledge. In case I have the answer, it is okay. In case I don't have the answer, I will search and I will find the answer. So I only have to say that thank you very much, because this is my way of learning to share, and my way of learning to seek questions, and only I'm doing it only to add my knowledge and experience. And thank you very much for participating. Thanks a lot.
Further, we will be sharing the link to the YouTube link to the recording of this webinar, and I think that will be available to all of you, all the participants, and that will be sent to the email address through which you have registered on this webinar.
See, we also have a AAA channel, AAA Insolvency channel on YouTube, and if you will go there, and you will actually see all our earlier recordings of webinars there.
Thank you so much. Thank you everyone for such a response. I'm really sorry to those people whose question I could not take up, and we will be able to answer the questions separately, maybe post the webinar, as Anil sir has already said. Thank you.
Thank you very much. Thanks a lot.